Anybody out there telling you to buy the dip in this market in any meaningful amount of size is completely wrong and is really going to cause a lot of pain for you and your portfolio moving forward here. We have a lot to talk about in this video, guys. We have the market going all over the place, the dollar selling off. We have the bond yields going all over the place. We have China striking back with 125% tariffs. We have some inflation data, some inflation expectations data that we have to take a look at as well. Guys, I have said this time and time again in these videos here that it is better to be late than wrong. I don't want to waste any of your guys' time. Let's get into this here. Again, if you do enjoy the information and analysis I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot, spreading these videos out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure that you guys are subscribed and turn on notifications so you're notified every time these videos do go live. And again, with all the volatility that we are seeing in markets now, for those of you guys that are day traders taking advantage of this, again, one of the main problems that day traders do have is being significantly undercapitalized. That's where a lot of these prop firms come in. Again, Take Profit Trader is doing an absolutely insane deal for you guys right now. If you guys use code VIX with the link down below, again, you guys are going to get 30% off for life, no activation fee, no consistency rule once you pass their evaluation, and you get daily payouts. I've never seen anything like that. That is absolutely nuts. But let's get into this over here, team. China strikes back with 125% tariffs on U.S. goods as trade war intensifies. China retaliated against the U.S. President Donald Trump's country-specific tariffs by raising its levies on U.S. goods to 125% from 84%. The Trump administration confirmed to CNBC on Thursday that the U.S. tariff rate on Chinese imports now effectively totals 145%. Now, moving down a little bit further here, even if the U.S. continues to impose higher tariffs, it will no longer make economic sense and will become a joke in the history of world economy, the ministry said in a statement. With tariff rates at the current level, there is no longer a market for U.S. goods imported to China, the statement noted, adding that if the U.S. government continues to increase tariffs on China, Beijing will ignore. Now, there's been a lot of talks, potential for a deal or a meeting to happen between the current Trump administration and China. But when we take a look over here, just hours before China announced new retaliatory tariffs, the Trump administration privately warned Chinese officials against such actions and reiterated that President Xi should initiate a call with President Trump, a source said. However, China proceeded with tariff hikes and made no request for a leader-level dialogue here. Guys, this is, again, something that a lot of people are missing in this whole situation, and that is even after the walking back of these new reciprocal tariffs, nothing really has changed when you think about the overall effective and average tariff rates in the United States right now. When we come over here, before Wednesday, we had about 27% average effective tariff rate on all of these imported goods into the United States. And after Wednesday, when this suspension did happen and this 90-day delay did happen, well, we actually went up a little bit to about 27% here with this average effective tariff rate. So if you guys were out here buying the dip and your old thesis for buying the dip was that we're no longer going to have a lot of these tariffs anymore, again, guys, I talk about this all the time. Information is so incredibly important in this market, and you have to understand that this situation is going to take a long time to play out. You should not be in any rush to be making any decisions in this market, and as we're going to go through in the rest of this video here, it is possible that we could have a lot more downside ahead. Now, there are a couple of things that people are just not necessarily realizing about this whole situation here as it relates to the inflationary effects of these tariffs. Now, again, it is not inflationary because inflation is really the rate of change. What we would see with these tariffs, again, is really a one-time price shock that could easily get absorbed. But the problem is that a lot of these companies that are going to have their cost of goods going up are not going to be able to command higher prices from the market for a variety of reasons. One of them is this: consumer sentiment, something that we have been talking about time and time again on this channel here, has plunged 11% this month to a preliminary reading of 50.8, the second lowest reading on record going back to 1952. April's reading was lower than anything seen during the Great Recession. Now, I want you guys to think about consumer sentiment and consumer spending behaviors when confidence and sentiment is this low in the economy. Consumers do not spend money, so demand is going to drop significantly. All of these producers and these corporations that think that they're going to be able to pass the costs of the higher cost of goods down to the consumer are in for a rude awakening, because the consumers are not going to be spending money. What this is then going to do is keep prices at a relatively constant level, but margins across the board are going to shrink. What happens when margins shrink? Companies become less profitable, growth rates slow down, and you can easily see this as a significant drag on GDP, which again is kind of feeding into everything that we've been talking about here on this channel. The other thing that we have to think about, which again, this is just absolutely crazy here, that the Democrats' one-year inflation expectations are 7.9%. That's not going to happen. You also have the Republican one-year inflation expectations at 0.9%. But there is something incredibly important about this chart here that nobody is really talking about. And again, shout out to all of you guys that are watching these videos all the way through, making sure that you understand these things, because look what we're seeing here. This green line is independents. If you think about what happened in the last election here, the independents were leaning much more towards the Republican and MAGA and Trump side than they were towards the Harris side. When we started to see inflation expectations moving to the upside here in blue with Democrats, well, these independents expectations for inflation were actually moving down. So they were, let's say, believing more so what the Trump administration was saying. And again, this Republican one-year inflation expectation was moving aggressively to the downside. With this vertical move with the independents here now projecting inflation to go to 6.2%, that's still not going to happen. But if you think about their overall attitudes and feelings towards this new administration and their actions, well, they are losing a lot of trust in these new economic policies moving forward. Now, there's been a lot of talk about midterms, and if this isn't resolved and we don't end up kind of in a better spot by then, that again, the Republicans are going to have some significant issues. But in the present here, again, having this group of people that were at one time very supportive of a lot of these policies here and now are not, because they again are now thinking that these policies are going to be inflationary, is not a good sign for markets moving forward. Now, the other interesting thing about this chart here too, guys, is we are talking about the independents really kind of showing us that they are not a fan of these policies anymore. Well, the Republicans are also kind of saying, we actually think there might be some inflationary effect now. If this starts to really move vertical to the upside here and inflation expectations across the board are going to move a lot higher. Again, guys, that is not going to be a good sign for the markets, and it is a signal that the citizens of the United States are losing faith in this new administration. Now, speaking about losing faith, we also have to talk about the dollar and bond yields. When the dollar moves like this, there are going to be a lot of questions as to whether this could be good for equities. Again, sometimes when people think about the dollar going down, this could be really good for risk assets. But again, context always matters. Having the dollar move down like this is really not a good sign in the present. And we can also see that bond yields are moving significantly to the upside too. So we see a sale of basically US dollar denominated assets here. The dollar is moving down, markets are moving down. What is this actually showing us? It is showing a flight out of the United States. We've talked about this a lot on the channel leading into this year, in this year so far, that it was very likely that we were going to see these foreign markets starting to outperform US markets. And that's what we started to see, and now it is starting to pick up even more as foreign investors are very worried with all the uncertainty in US markets going throughout the rest of this year. that they are selling bonds. Again, we also have that element of the bond vigilantes there, which we can talk about in another video, but effectively, they are selling bonds at an unprecedented pace in order to get this new administration to change course to some more responsible policy. But overall, there's a lot of speculation to whether or not this is China selling, whether or not this is other foreign governments selling. Again, we can look at that in kind of pontificate some of those issues there, whether or not it is China and who this actually is. But the fact remains, yields moving up like this is not good. Mortgage rates go up. The cost of borrowing goes up. Business activity goes down. Again, with overall consumer sentiment in the gutter already, you have to think about how that trickles up to net new investment and how this would work moving forward. If interest rates are higher, if the overall economic climate is very, very uncertain, well, you're not going to be able to raise capital from a lot of these other sources in order to continue this American innovation and growth that we were witnessing in prior years. Some of you guys might look at this now and say, well, we're just kind of back at levels that we were at in February here, but it's the speed and aggressiveness of this move that is very, very worrying. And if this continues and we see a 10-year back at 4.8 or 5%, this market is going to have even more problems here. And again, just thinking back to what we were saying before, just looking at this chart of the S&P 500 ETF, the SPY. This, again, guys, I was talking about this on Twitter. I was talking about it in the YouTube videos here. This was a bull trap. Again, a lot of people just did not realize that the effective tariff rate was not actually all that changed. Nothing really changed with this situation except for the fact that they are open to more deal making, which we kind of already knew before. I would be very, very careful in this market, guys. Again, if you are somebody that already has a scheduled dollar cost averaging plan, I would say don't change that. But again, nothing in these videos here is financial advice. I'm not your mom. You guys do whatever you want. If you guys want to buy the dip here, or if you bought the dip up here, or not the dip, but the rip up here, good luck to you. I think there is still a lot more volatility and potential downside in this market here. And again, I would say to you guys that are a little bit kind of confused about what's happening or wondering what to look for in order to really start considering buying in any significant amount of size for you, going back into this market is going to be not price action. It is going to be whether or not the big picture situation and macroeconomic situation is changing. Are we going to be able to come to a deal with China? What are the deals that are going to come from a lot of these EU negotiations? How does the economic data look in the US markets? Are we continuously seeing CPI moving down, growth moving down, and unemployment moving up? And that brings us higher potential for rate cuts, more rate cuts faster in the near future. Those are the things that you have to focus on. Do not let this type of price action bait you into making stupid decisions. I've been saying this a lot to the private group. The dangerous part of this market is not these aggressive moves down. It's these aggressive moves up, because they can really mess with your emotions, thinking that we are so back when in reality we are not. So guys, that is going to wrap up this video here. If you did enjoy the information and analysis I provided for you guys, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot, spreading these videos out to as many people who actually want to learn about this market and what's actually going on. And again, if you never want to miss another video like this, make sure you're subscribed, turn on notifications. But until next time, guys, I will see you. Peace.